Hello and welcome to Economy and World. Today's topic is essential to understand where your money is heading in 2026. Because on that late-month trading session, we did not only see a drop in metal prices, we saw the dismantling of an investment thesis that many believed was untouchable. To understand the magnitude, that day, gold futures collapsed by 11%, and silver plunged by 31%. Marking the largest single-session decline since 1980. What happened is that $600 billion in market capitalization evaporated before the morning in New York had even ended. The name that triggered this entire mechanism was Kevin Warsh. When he was nominated by Trump to lead the Federal Reserve, financial markets did not react with irrational fear. They reacted with a technical reassessment of everything they had built over the past year. Throughout 2025, the market had been betting on a concept called political capture, assuming the president would install someone willing to print money without limits in order to finance public spending. However, Warsh represents exactly the opposite, and that is the first major lesson we must analyze today. Kevin Warsh is not a typical bureaucrat. At 55 years old, he is a former Morgan Stanley banker who already operated inside the heart of the Fed during the 2008 financial crisis. Unlike the academics who usually run these institutions, Warsh understands how the gears of Wall Street work, leverage, and collateral chains. What we need to understand, and what many other channels overlook, is that Warsh is a defender of institutional independence. The moment his name was announced, large investment funds understood that the scenario of a Fed submissive to the White House had disappeared. This triggered the simultaneous unwinding of all positions that had been built as protection against an aggressive devaluation of the dollar. It was a massive deleveraging. The debt pyramids and paper contracts that had pushed gold up to $5,600 collapsed because the original premise was no longer valid. But here is where our analysis goes deeper. It is not only about who the man is, it is about the thesis he brings with him. Productivity driven by artificial intelligence. Warsh argues that AI is changing the speed limit of the economy. This is the technical explanation behind why he believes interest rates can be lowered without creating inflation. If technology truly makes the economy far more efficient, growth can accelerate without prices exploding. This idea is what has strengthened the dollar and has reduced gold's appeal as an inflation hedge. However, we must ask what happens if this productivity does not show up in real data over the coming months. Right now, core inflation is still running at 3%, well above the Fed's target. Warsh inherits an institution that must choose between trusting a technological promise or confronting a reality of sticky prices. If the inflation data for February and March do not decline, Warsh's more aggressive instincts will awaken. He has always been a hard money hawk. That means the Fed could keep rates high for much longer than the market now expects. This would create a volatility scenario that we are only beginning to glimpse. Another critical point we must dissect is the conflict in the Senate. This is not simply about naming someone and moving on. Senator Thom Tillis has created an unprecedented institutional blockade by tying Warsh's confirmation to the resolution of the criminal investigation involving Jerome Powell. This is vital, because it creates a leadership vacuum that could last until May. While others tell you that Warsh is already in charge, we tell you that the market is operating under total uncertainty. If the confirmation is delayed, the risk premium that disappeared could return to precious metals prices. Markets hate vacuums, and a Federal Reserve without clear leadership in the middle of a fiscal crisis is the perfect recipe for gold to regain its appeal. You must closely watch the statements coming from the Department of Justice regarding Powell, because that is where the market calendar for the rest of the year is being decided. Now let's talk about the difference between political capture risk and fiscal sustainability risk. With the nomination, the first one was resolved. We now know that the Fed will not become a political office of Trump. But fiscal risk is now larger than ever. The United States is running a deficit equal to 6% of GDP. Roughly $1.8 trillion per year. Warsh may be independent, and he may defend the currency, but he has no control over Congress and no control over defense and infrastructure spending promises. If the government keeps spending while the Fed stops monetizing debt, what we will see is a massive rise in bond yields. On the session of the crash, the real yield on the 10-year bond rose to 1.9%, directly competing with gold. What this means is that the market is no longer afraid that the dollar will die because of money printing. Now the market is watching whether the debt system itself can survive with such high real rates. This is a complete game changer, and it requires you to rethink your investment strategy. We cannot forget the role of foreign central banks. While retail investors in the West panicked, institutions in China, Russia, and the BRICS bloc have continued to accumulate reserves. Last year, they bought nearly 900 tons of gold, and this trend does not stop because of a change at the Fed. For these countries, gold is not a short-term inflation trade. It is a strategic diversification tool against a dollar-based system they view as increasingly politicized through sanctions. The key point of our analysis is this. Even if Warsh stabilizes the perception of the dollar in the short term, the geopolitical foundations behind de-dollarization remain intact. For many of these central banks, the price collapse was the perfect opportunity to buy more at a discount of what they consider a long-term national survival asset. So the question that remains after the crash is this. Are we facing a true trend change or simply a necessary correction? Gold rose too fast in 2025, driven by fear. What Warsh's nomination did was puncture that fear bubble, but it did not eliminate the reality of United States debt, and it did not eliminate global conflicts. If we look at Warsh's history, we see a man who prefers stability over artificial growth. This could lead to a strong dollar for several months, but it will test the resilience of the entire global financial system. What we witnessed was only the prologue, a battle between monetary discipline and fiscal excess. At Economy and World, our goal is for you to understand that the price you see on your screen is only the symptom. The disease is still a level of debt that no Fed chair, no matter how independent, can erase with a speech. But this is only the beginning. Because if we truly want to understand the real scale of the disaster, we have to look beyond gold and focus on the massacre that took place in silver. While gold fell 11%, silver was literally wiped off the map with a collapse of 31%. Many people ask why the difference was so violent, and the answer is technical. Leverage. Silver is known as the poor man's gold, but on Wall Street it is the playground of derivatives. Throughout 2025, a massive mountain of paper contracts, options, and futures was built, all betting on silver above $100. When the news about Kevin Warsh hit Bloomberg terminals, that mountain turned into an avalanche. Institutions that were long silver began receiving margin calls, forcing them to sell at any price to cover losses, creating a feedback loop in which every drop triggered even more forced selling. This was the moment the market rediscovered gravity in the most painful way possible, moving from near irrational euphoria to full liquidation in just a few hours. What makes this move so different from other collapses is the figure of Kevin Warsh. Unlike Jerome Powell, who is widely seen as a lawyer who follows the consensus of PhD economists, Warsh is a market operator. His background at Morgan Stanley and his time at the Fed during the 2008 financial crisis position him as someone who does not just read reports, but actually understands how collateral flows between the major banks. The market sees him as the ultimate translator between monetary theory and the reality of Wall Street. His nomination sent a regime message. The era of dependence on backward-looking data is over, and the era of forward-looking judgment has begun. But this is where the most controversial and least understood part of his strategy comes in. His thesis on productivity driven by artificial intelligence. Warsh argues that the technological leap we are experiencing, with productivity rising by 4.9% in the third quarter of last year, is the secret weapon of the United States. According to his logic, if we can produce far more with less effort thanks to AI, the economy can grow strongly without pushing prices higher. It is the perfect intellectual justification for cutting interest rates without looking like a political puppet. However, this thesis is a double-edged sword that investors must watch extremely closely. If the benefits of AI do not pass through quickly to consumer prices and inflation remains stuck above 3%, Warsh will be trapped in a contradiction. His historical instincts are hawkish. He is someone who protects the value of the dollar at all costs. But his current alignment with the White House suggests a more expansionary stance. This internal tension is what triggered the collapse, because the market removed the risk premium that had been priced in for fear of a politically captured Fed. Now the risk has shifted. We no longer fear that the Fed will become an office of Trump. We now fear that the Fed is betting the entire stability of the economy on a technological miracle that may take longer than expected to materialize. This is a shift from political risk to execution risk. And execution risk is usually much harder for precious metals markets to price. Meanwhile, in the capital, an institutional blockade is taking shape that could give back to gold everything it lost on January 30th. Senator Tom Tillis has pledged to block any nomination until the Department of Justice investigation into Jerome Powell, related to the renovation costs of the Fed's headquarters, is clarified. This is not just a procedural issue. It is a defense of institutional independence that has even united figures as politically opposed as Tillis and Elizabeth Warren. If by May of 2026, when Powell's term expires, Warsh has not been confirmed, the Federal Reserve will enter a period of interim leadership or technical decapitation. Markets hate power vacuums, and a Fed without a clear leader in the middle of a 6% fiscal deficit is the perfect environment for investors to rush back into gold and silver. We must understand that the collapse was a reaction to a nomination announcement, not to an actual change in leadership. And between announcement and confirmation, there is a deep abyss of legislative uncertainty. That is why, at Economy and World, our focus must be on separating price noise from fundamental reality. The collapse was a necessary cleanup of a market that was overbought and crowded with short-term speculators. But nothing that happened that day fixed the structural problems. The $1.8 trillion deficit is still there. The $34 trillion of debt are still there. What Warsh brings is credibility. But credibility does not pay interest on the debt if yields continue to rise. The real yield on 10-year bonds touched 1.9%, a level that directly competes with gold because it offers a positive real return. But if inflation remains sticky and nominal yields rise faster than inflation expectations, the cost of servicing United States debt will become unbearable, eventually forcing an intervention that weakens the dollar again. We are in a chess match in which the crash was only a pawn move. The fiscal checkmate remains the underlying threat. We also cannot ignore what is happening beyond our borders. Central banks from the BRICS bloc, and especially China, have been watching this collapse with strategic interest. China recently reclassified silver as a material of national strategic importance, restricting exports and accumulating physical reserves. For them, the price drop was a golden opportunity to continue diversifying their reserves away from the dollar-based payment system. The correct interpretation is not that gold and silver are worth less today. It is that the Western paper market has capitulated, while the physical market in the East continues absorbing every available ounce at these discounted prices. A growing fracture is emerging between the price dictated by Wall Street algorithms and the value assigned by central banks preparing for a multipolar world. Warsh may try to stabilize the dollar through rhetoric about independence and technology, but he cannot stop the global trend of distrust toward a reserve currency that has been increasingly used as a geopolitical weapon in recent years. In conclusion, to navigate what remains of this 2026, we must stay calm and disciplined. The crash taught us that the market can be brutal to those who arrive late and with too much leverage. But for the long-term investor, the fundamentals that pushed gold to $5,600 have not changed. What has changed is the support mechanism. We are no longer rising because of fear of immediate chaos at the Fed. We are now in an observation phase, waiting to see whether the new administration and its star candidate can truly square the circle of cutting rates, promoting growth, and keeping inflation under control. Watch the 1.9% level in real bond yields very closely. If that level holds, metals will remain under pressure. But if the market begins to doubt Warsh's ability to control the fiscal imbalance, gold and silver will reclaim their throne faster than they lost it. This is not the end of the bull market. It is the beginning of a new era of volatility, where only those who understand the difference between political capture risk and fiscal risk will come out ahead. The situation on Capitol Hill is not just a political anecdote. It is a Gordian knot that the market has not yet fully digested. We must understand that the confirmation of Kevin Warsh will not be a victory parade. Senator Tom Tillis has raised an institutional challenge that could paralyze United States monetary policy at a critical moment. With a Republican majority of 53 seats, the margin for error is extremely thin. In the Banking Committee, where the balance is 13 Republicans versus 11 Democrats, a single vote against the nomination, such as Tillis's, would create a 12-12 deadlock. Breaking that blockade would require 60 votes on the Senate floor to force the nomination out of committee, something that looks almost impossible without massive Democratic support that does not exist today. This paralysis means that even though the market celebrated the arrival of an independent hawk, the reality is that Jerome Powell could be forced to stay beyond May or leave the Fed in the hands of an uncertain interim leadership. That uncertainty is poison for the dollar and long-term oxygen for gold. While this political battle unfolds, the mining sector is entering a danger zone that very few analysts are watching. The collapse did not only erase gains on trading screens, it pushed many mining companies below their all-in sustaining cost. Average extraction costs have risen sharply due to input inflation and falling ore grades at older mines. If the gold price consolidates below $4,800 for a prolonged period, we will begin to see a reduction in global mine supply as the least efficient projects stop being profitable. This is one of the market's great ironies. The same crash that scared investors may be planting the seeds of the next major rally through a future shortage of physical supply. It was a warning for speculators. But for producers, it is a signal that they must tighten their belts or face bankruptcy. Now let's talk about what really matters for the coming months: the liquidity trap and real yields. The market decided that a 1.9% real yield on the 10-year bond was enough to abandon gold. But that figure is misleading. That real yield is calculated by subtracting expected inflation from the nominal yield. If actual inflation ends up being higher than what the market expects, that 1.9% yield evaporates, pushing bond investors back into negative real territory. Warsh is betting on artificial intelligence productivity to keep inflation under control. But if energy and commodity costs continue to rise because of tensions in the Middle East and Ukraine, no software efficiency gains will be able to offset the rising cost of the physical economy. We are in a race between technological innovation and fiscal monetary degradation. That drop was the first lap of that race. And although technology appeared to win the opening round, the debt marathon has only just begun. We must also analyze the behavior of the smart money. While gold fell to $4,700, we saw a massive wave of buy orders entering at key support levels. This tells us that institutional capital has not abandoned the market. It simply took advantage of retail liquidation to improve its average entry price. The World Gold Council has confirmed that 95% of central bankers plan to increase their reserves over the next 12 months. For them, this was a market price anomaly, not a change in the strategic value of gold. They look at a 6.1% fiscal deficit relative to GDP and understand that, with or without Warsh, the trajectory of United States debt is mathematically unsustainable without a future currency devaluation. In the silver market, the situation is even more tense. After the 31% collapse, the gold-to-silver ratio surged to levels that have historically preceded violent rebounds. Silver is not only a monetary asset. It is a critical input for the energy transition and for the semiconductor industry that powers the very artificial intelligence Warsh is betting on. There is a fundamental contradiction here. You cannot have a technological productivity boom without massive demand for silver. The market ignored silver's industrial role and focused only on its financial collapse. But the reality of physical supply and demand will eventually impose itself on paper contracts. If we look toward the end of 2026, the scenarios are clearly divided. In the base case, inflation gradually falls to 2.5%, and Warsh manages to implement 2 or 3 rate cuts. keeping gold in a consolidation range between $4,700 and $5,000. But in the bullish scenario, if inflation remains above 3% and the fiscal deficit continues to expand, faith in artificial intelligence productivity will fade, and gold will once again attack the highs near $5,600. That purge cleansed the market of financial tourists, leaving only investors who understand that gold is the ultimate insurance against a debt system that has reached the limits of its expansion. The real question you must ask yourself is this: do you trust the ability of one man, no matter how brilliant Kevin Warsh may be, to stop a $34 trillion debt tide? Or do you trust gold's 5,000-year history as a store of value? The facts reminded us that the paper market can be manipulated and can collapse quickly, but it cannot erase the physical scarcity of precious metals. The Federal Reserve independence that Warsh promises to defend is necessary, but it is not sufficient if the government does not match it with fiscal discipline. And in an election year filled with spending promises, fiscal discipline is the last thing we should expect in Washington. Therefore, this crash should be seen as a technical pause, a reset of expectations, not as the end of the real assets era. The system has moved from political capture risk to fiscal insolvency risk. And on that new battlefield, gold remains the king of safety. Do not let short-term volatility distract you. Keep your focus on the fundamentals that have not changed at all. This concludes our analysis. Thank you for listening. And don't forget to subscribe so our community can continue to grow. Thank you.